Hello there, it's Helen Chorley from Property Sisters UK, and we have another superstar chatting to us today about the 2021 outlook for property market. It is the one and only Richard Little. Thank you for joining us, Richard. We always love listening to what you have to say and bringing your dose of hyper-realism to conversation. How are you?
I'm very well, thanks, Helen. Yeah, thanks for hosting me, if you like, if that's what it is. But yeah, not sure about the superstar, but I'll take it. You know, whatever. Take any win you can at the moment, won't you? So, yeah.
Absolutely. And what are your thoughts for, you're kind of very much kind of into the land and the development side of things.
Yeah.
What are your thoughts on that area for this year?
Okay, so we're still driven. Obviously, much of our stuff is longer plays, as you well know. So we'll start a project now, and it might be 5 years, 5 years before we come out of it. But we're still driven by we're predominantly in the resi market. We're still driven by resi prices and resi confidence, etc. So like lots of other people that are sort of trying to forecast what's going to happen. Who really knows? But I think I'm. As you well know, hyper realist. I'm also been known as Mr. Doom and Gloom, party spoiler, whatever. And actually, I'm very, very optimistic about this year and the following year, which will probably surprise a few people. But I think the first thing you got to sort of say is that there's an awful lot of distress around. There's obviously health and issues, and people were losing people and all that. So we have to acknowledge that all the time. However, what you've got to say for entrepreneurs, if you like, in any sector, opportunity comes out of uncertainty, whether it's future or present or whatever. So massive opportunity for, I'm sure, property investors, but particularly from our point of view, from a developer's point of view, moving forward. So the uncertainty around resi prices, if you're in it for the longer play, whether it's longer play investors or longer projects, so longer lead times to developments, or you've got deal structures where you can sit and hold. You don't have to start. You just press the pause button. We have things like freezer clauses in various things whereby we can sit and stop. And all the parties, all the stakeholders will just say, oh, okay, it's not the right time to develop, it's not the right time to sell, borrow, or whatever else. So let's sit on it for 6 months, review, and then we start the clock ticking on the agreements again. So we've always got those in place. But where we see is most people are led by, property prices. That's it. And as I say, particularly from the resi point of view, what's going to happen to property prices? I don't know. My feelings from experience of, I don't know, fifth decade or whatever, is obviously even I'm not old enough to have gone through the last pandemic. So, but we've been through a number of recessions and we take lessons from those. So whatever happens to property prices over the next year or 2 years is really, really important to all of us, unless you're a longer term investor, in which case, you've got the cash. My own feel is that we've seen a spike in demand, a typical V-shaped sort of recovery, sort of post the summer, etc. That is still sort of being stoked up a little bit, but we've got the impending stamp duty end of the extension for that. Well, end of the break, sorry for that. And also we got Help to Buy, which changes in April as well. That will then be only for first-time buyers. That's going to have an impact on the market, which we're expecting. We would like to think that the stamp duty will get a further extension, but we don't know. There's nothing been announced yet, to be honest. They've got an awful lot of stuff on their plate anyway, so who knows? It might get slipped in. That's fundamental for me. What happens then as to what happens to the resi market for the rest of this year. And also we've got furlough ending. I think it's ending in April now. I don't know. That might get extended again, I suppose. And we'll start crystallising a lot of the redundancies, I guess, throughout this year. But so I suppose by Q3, Q4 this year, we'll have a very, very good idea of what the redundancy or unemployment is likely to look like for the next, perhaps couple of years. The forecasting will probably be more accurate by then. We'll also have, hopefully, fingers crossed, a lot more positivity around the vaccination program, and we'll see where that's coming, because I think that's about confidence and stuff to people, get people out there spending.
Absolutely.
You know, so I think overall, I think the year we're going to see a bit of softening the prices, no doubt. But I'm not predicting a fall off the cliff, I think is an expression that we've heard. I don't think that's going to happen this time. Whether that's me just getting old and soppy and hopeful or whatever, I don't know. I don't think it is. There simply is too much money around. But where we sit, the deals that we are doing now and structuring and pretty much structuring for a long while, is we always structure around about 90% of current value, resi value. So, but if there is any uplift in that value, that's something that we work with generally with the landowners, and they get a share later on. So all sorts of overages, clawbacks, and various stuff like that. And we don't really do deals with any landowners that aren't prepared to take a little bit of the risk. We're quite prepared to give some of the reward away because it lessens our risk. So we always go on the basis of what does it work at 90% of current values. And if it goes off the cliff, it could be 80% or 70% or whatever. Well, the point about there is being not overexposed.
Exactly.
You know, so I think, you know, that's where I see the market going. I think it's gonna I don't know, stagnate. It's gonna slow down. It's gonna whatever, and we might see a bit of softening, and then. But I see the year ending probably at similar values to probably pre-COVID, not now, but pre-COVID, which is probably what 6 or 7% off on average, I think, for resi stuff. You know, so I think that's where we'd be more than happy if that was the case. You know, a couple of projects we've got on, you know, that we are committed to. You know, ultimately, for us to de-risk, you know, if the sales market is not good, then we need to keep them. And so one of the things that we pretty much always do, we don't get involved in the super luxury market, the high value stuff. Lovely. We've been there before in the decades previously, and we haven't, you know, Dad was first generation, obviously, and the projects we've done over the decades since he started in the 50s, not one single one that we would call high quality luxury or whatever the words are now, you know, they didn't make anything like the returns of the normal affordable boxes, as we call them. Not, I mean, they're hopefully they're a little bit more than boxes, but the family homes, you know, now, you know, the 1, 2, 3, 4 bed affordable, whether that's socially or locally. So we're not straying from that. I mean, we've got more focus now on affordable, so working with registered providers who are already getting, so that's housing associations, councils, boroughs, etc. They're already getting money thrown at them by the government. And I mean, the government's mantra almost at the moment is build, build, build. And why I'm as optimistic as I am about the future is that is where the money will get spent, infrastructure and construction. And because the government, I'm not particularly a conservative by politics, but they do understand that is the way. You can't tax. Now is the wrong time to tax people. You know, we've got to invest, we've got to spend. When I know we've invested a lot of money, or somebody's invested a lot of money in furlough schemes, etc. I'm not too bothered about that, because a lot of the competing countries in the world are in the same boat. You know, so there's a lot of debt around, but equally there's a lot of cash. So our focus is much more on a firmer exit. So doing deals that bring on housing associations, to say local councils, London boroughs, etc. in the exit, much might be lower margins, but very safe. Very safe margins. You know, you've done the deal beforehand, and stuff where we've got sites, because we've got sites from, you know, from sort of 9 units, I think it's the smallest site, to we just had a meeting this morning about 20 acres. So there's 200 on there, which is way bigger than we will ever do, but we can phase it. And so the stuff that we can't secure an exit for, we're very much now looking at the sort of you know, build to rent type thing, where we're going to hold, or somebody, an entity is going to hold a lot of that, because again, it's a safe exit. But it's all about lower value stuff. So it's all about affordable for us. It's about, you know, and whatever happens for me for whether it's, you know, unemployment is obviously going to go up, and whether, you know, wages get squeezed, which they probably will through taxation, etc. So people's money in their pockets going to be less. They're going to have less to afford on their mortgage, less to afford on their rent. Affordability is everything.
Yeah.
So if you're, whatever you're developing, you know, or investing in, if it's not if it's out of the affordable bracket, then it carries a bigger risk. Doesn't mean to say it won't work, but it carries a bigger risk. And our sort of business is to reduce risk, not to increase it, you know.
Absolutely, like you say, and have that certainty of exit. You're appealing to the widest market that you can. You've got the certainty of exit, and also what I love when I speak to you is, like, you know, you're not beholden to those monthly ups and downs. You can ride that wave of, well, we're up this month, we're down this month in price terms, because your time frame, your horizon is so much longer. And that's the beauty of being in that position, that you're not, you know, kind of driven and pushed and shoved and by those considerations. So
yeah, you know, yeah, we're very fortunate, been around a long time. We've hopefully made our biggest mistakes, hopefully. They're past us and we've learned from them, you know. And it's very unfortunate. I see a lot of people entering into the development space that are full of positivity and action and all the stuff that goes with that, and I get all that sort of stuff. Unfortunately, that's not enough to make something work. And you know, you and I come from a similar place, stoicism, whatever, you know, reality or whatever, and it's considered boring and all that sort of stuff, but we'll still be there, you know. Whereas, and we still are here, you know. We've had a lot of ups and downs, and not because we're super clever. It's just because we sometimes stand back and say, "Ooh, we don't get seduced," if that's the right word, by the shiny pennies. We do a little bit, but we eventually we come to our senses and say, "No, that's you know, it sounds too good," so it obviously is. But I think there's lots of opportunities, and this will come in from investors as well. Really, is you know, distressed sales. You know, again, what I said before. Obviously, you know, a lot of opportunity, a lot of money is made out of other people's misfortune now, and that's hard for some people to even enter into discussions with people that are perhaps losing their business, because they get drawn in. It's hard not to get drawn into it, but you always have to stand back and say, I haven't caused their problem.
Yes.
Am I doing the very, very best I can do to help them out of that situation, and not trying to pull the rug from under them? There's a lot of that about. But if you do, then don't feel guilty about it. You know, if they've lost their house and lost their business, you haven't caused that. But if you actually do as much as you can and get them a good deal, so a massive amount of distressed sales, and they probably won't really be in abundance till Q3, Q4, I suspect, because these things take so long. I mean, we've still got stuff from the last downturn 10 years ago that hasn't reached the market yet. You know, where investors and funders have just held on to it because they hope that one day it might be worth a few quid, or at the moment it's on their books at a false valuation, so they can't release it. So anyway, we today's not a discussion for that. But so, and I think what we'll also see now throughout this year is more motivated deals. So more people motivated for a change of life circumstance, and not just in the bad way that we're talking about before, but actually they're fed up of all this and they want a different type of life, and they want to move to more space, more to the seaside, wherever. I think we'll see a lot more of those. You know, I mean, we just got a deal, went over the line. I think it was just before Christmas, and that's been long standing in legals, but they've got to the point. The family, we work very closely with family groups generally. They got to the point they just want to move on, and they pretty much trust us as much as they can to make sure that we're all going to get a good deal out of it, because they're brought into the end result, as I said before, and they're just motivated, they want to get on. And so I think they're quite typical. Look, we're fed up with this COVID thing. You know, we actually want some money in our pocket now. We've just agreed to buy some land. It was a builder, it was a developer. He's retiring. He's the same age as me, but he wants to move on. And we're buying a couple of acres for 20 grand. 2.5 acres for 20 grand, because he needs 20 grand. But he's going to get the back end. That's the first time we've ever brought anything unconditional. But at 20 grand, it's we will get permission on it. It will be worth around about 800k. you know, and it'll probably be worth 800k, you know, maybe the back end of this year on paper.
Yeah.
Once we get some planning stuff sorted, but he needs 20k, but he's going to get a percentage of that back end, that uplift. You know, he wants to move to he's got enough money. He hasn't quite got, he needs £20,000 to buy this mobile home thing in Cornwall or whatever. You know, and so we're not trying to think. He actually did want 30 grand, but we were going 30 grand all in with fees. So, you know, so motivated deals.
Yeah.
You know, a lot of those, I think. And obviously people are probably aware of the changes to planning that we had, the reclassification of use classes all coming into E and all that. And that's with accompanied with, sorry, just getting rid of that. Something's trying to interrupt us. Sorry, my techie issue this end. So yeah, with PD or prior approval and prior approval, there's going to be a lot of opportunity sitting there, but some of it's still unknown. You know, it's like the roof space stuff and all that. I see a lot of people, you know, spouting about it. They still don't know all of these changes. You know, I'm not a first adopter. I'm a sort of let somebody else adopt it first, and we'll follow them. And we've got a consultation document out at the moment, which is gonna, it's going to ease the planning process. It really is a good document for anybody that hasn't seen it. Consultation ends in February, I think it is, and we'll probably see some of that come through this year. However, there's a lot of changes in there that local planning authorities are going to fight. So again, don't be early adopters. We're sitting on it at the moment because there's some idea that you won't have affordable on possibly even up to 50 unit developments. Well, that makes a massive difference. People think it doesn't. Right. Actually, what it does, it makes the project weaker because people don't understand how affordable works. So if we've got a project of 50 units and let's just for ease say 50% of them are affordable, we've got a guaranteed exit on 50% of them. Yes, it lowers the value of the land, but so will the NEIL scheme, because they're not just going to give you it, they're going to take a sum of money instead. Yeah. So all of a sudden, instead of having a project where we've got 25 to sell on the market, of which we could probably keep half of them, so we probably don't need to sell all of them anyway, we will have to sell all 50. And people that are in multi-unit development don't understand phasing. They don't understand how funding works through phasing and all that. So there's a lot of people saying, oh, this is brilliant, this is brilliant. No, it's not. It won't be a bad thing, don't get me wrong, but it's not what people believe it's going to be. So local authority is going to fight this, and you know, and they're going to get X amount per unit and all that sort of stuff. You know, but I think clearly for us, the biggest opportunity is at the affordable market, purely affordable in some sites. You know, where say a lot of housing associations and other registered providers have got the funds. Not all of them, but some of them have got the funds to actually go out there and pay, you know, the going rate. Yeah. You know, so
I just love listening to you because you always have a different kind of take on things. And as you say, like the headline, or you know, people look at something and there's an automatic assumption about kind of a headline news. Naturally, the devil is in the detail, as you say. So and you bring so much experience because you've seen so much of this that I love the way you provoke people to really think about what they're looking at. And I love your message of there's going to be huge opportunity this year, but as ever, kind of be cautious and leave yourself that buffer and and kind of play it safe. And I love the don't be an early adopter. That's very much my book too. So
pioneers often throughout history don't do very well. They might reach the history books, but they don't do very well financially, and they don't always live that long either. But that's another story. I've got one word of caution though, and this is probably the sort of space that you're in, and people that aren't so well experienced as you in what I would say to smaller investors in development. I'm not talking about in finished units. In development is you might see your margins squeezed because there's so much money around. Some of the bigger players will be reaching out to people with decent deals and taking a share of those deals. And I've seen it before, and I do think, and I think, you and I talk fairly often, and I know you're experienced in this, but I think there are a lot of people that are peer investors in the development space that don't really know what's likely to come. And so they'll end up getting lower margins in riskier investments.
Yeah.
And that's a real concern. And I know you and your fellow property sisters and all that, it's the message you're going out there and the whole education thing, and people are encouraging people. And it's a really risky time to be. When I say smaller investor, I'm talking about non-institutional.
Yes.
So you might have millions, you're still a
Yeah.
smaller investor in the in the space. And that's a bit of a word of warning for people, because we know, and now it's not the same, but back to, you know, the biggest recession in that affected us from a business was in the late 80s, early 90s, and that's when we had double-digit interest rates, and we did. You know, us old timers talk about, you know, it's 15%, which it was for a brief period of time on a Thursday afternoon or whatever, but it was still double digits, which was okay for us because at the time we had a massive amount of cash, so we were doing fantastic. But anyway, that was just pure luck. It wasn't skill. Is that what happened then? We had offers for investment in land assets, and they would charge about 3 to 4%. Because there's nowhere for their money to go safely. Land is safe. Built units are safe. Land is safe. You know, anything in between is riskier, which they'll look for a bigger. But there's always money around for land. And where are we going to? And this is where they say what I said before about the government. You know, the steering towards the build thing. That's where. So a lot of people in the property sector, investors, property entrepreneurs, whatever they want to call themselves, massive opportunity. Probably the biggest opportunity in my lifetime, I suspect. You know, but equally, a lot of them will get it wrong because they'll get greedy, etc. So that's where I'm sort of being, you know, a message of caution to people that are purely invested with developers. Oh, you know, they might be very positive and put out all that, and they might be really sound, but things can happen really quickly. And if they're overexposed to the market and they've got 6 or 7, so beware of people that have got 10 or 12 projects on. That's too many at the moment.
Yeah.
You know, we've cut down on our desk. We cut down a lot of the stuff. We were going back out to vendor. We do a lot of direct to vendor. We were going back out as early as July, August last year, and we decided not to. We did feel it was quite the right time, and we haven't even been back out. The deals we're doing now are stuff that has either come into us, and for the first time ever, we've done 2 deals through agents. Never purchased through an agent before, ever. We've done 2 deals now that have come, and so for us now, agents, because not all of it, direct to vendor is quite good, but you know, so we're concentrating on less now. Less is more, or whoever said that, I don't know, but focus on what you've got on your plate rather than taking, before you take something new on, you know, from an investor's point of view, money in the bank, it might be losing money, but it's not losing money.
Exactly. You've got the inflation challenge, but it's still there. And I completely agree with what you say from a, you know, a passive, or let's call it hands-free investor's perspective. I need to know, and I'm looking more and more focus on, can that person and that developer and that business survive as much as the deal? It might be a great deal, but again, if you've got overexposure, and we've seen it time and time again, if you overexpose yourself on you know, taking on a huge amount of projects, it jeopardizes mine, and I might not be in the other ones, but it jeopardizes mine if there's overexposure. So I love those words of caution. Thank you so much for joining us, bringing that
pleasure as always.
words of wisdom, and hopefully we'll catch up with you later in the year, see how things are going and see where we end up.
Yeah, hopefully so.
Thank you.